Welcome to Long Story Short, a podcast where two financial advisors, one rooted in financial planning, the other in investment strategy, break down the questions we're actually hearing from our clients. Each episode, we tackle one or two real-world issues that matter to high net worth individuals, from market-moving news to personal finance decisions with lasting impact. No jargon, no fluff, just clear, thoughtful insights from the front lines of wealth management. We keep it short, but we don't cut corners. This is Long Story Short.
So Andy, something happened today that normally doesn't happen, and you alerted me to the attire you would be wearing to our recording today.
That's right. I was telling you what I was wearing earlier today.
You were forecasting ahead of time what you'd be wearing, which was for good reason, because college football season kicks off this upcoming weekend, officially. And
we don't count week 0. Iowa State, Kansas State. That was fun over there in Ireland, but that's not the official kickoff.
So why don't you tell everyone, especially for those that are listening, not watching, about your shirt?
Yes, so as my guys, Dan and Ty, on one of my favorite college football podcasts, The Solid Verbal, say, not a sponsor, could be. Roback is the shirt. It's got all these little tiny VT logos on it. Honestly, if you're watching the video, you may not even be able to see it, but we pull the curtain back a little bit. We record this podcast middle of the week, beginning of the week, and it doesn't get published until Friday. So if you're listening to this, we had games yesterday. We have games tonight. We have games tomorrow, this weekend. Our team, Adam, plays Sunday. Are you going to Atlanta?
I'm not going to Atlanta. I've got blinders on when it comes to Virginia Tech football performance. As you can see, I'm not wearing any Virginia Tech memorabilia, and I will watch the game, but I've not yet committed my travel time to going to see them again.
Yeah, one thing people may not know about me, like college football is my absolute favorite sport. Absolute one seed. So to me, like, this is like a national holiday. Whether my team is going to be good or bad. Yeah.
Well, I've got to ask you on that note, what are you more excited about, college football or annuities?
Well, let's see. I'd say that, like college football, annuities can make sense, or sometimes they're just absolute madness, right? So I might be a little bit more excited for college football, but I see at least some similarities between the two. So I think annuities are a really, really interesting product here. Should we group, in your opinion, should we group annuities and life insurance products together, or are they different enough to warrant separate discussions?
They're separate.
They're separate.
They are separate discussions.
Mm-hmm.
Annuities are, it's hard. I don't like overgeneralizations with anything in finance. People say, I don't like stocks. Well, what does that mean? There's 10,000 plus publicly traded companies around the world. Stocks come in different flavors. Annuities are in order of magnitude more complex, confusing, expensive, and of various structures to individual stocks. But and especially today with the annuity market, what it's turned into is it's gotten more and more confusing. It's hard to overgeneralize. There's index annuities, there's variable annuities, and then there's all kinds of riders and bells and whistles you can pay for to add over top of your annuity, and all the insurers design them a little bit differently. Our general stance is, in an overwhelming majority of cases, they do not make sense. Or at the very least, they're not the most optimal of available solutions. And so what do you think, Andy? Should we just kind of walk through our general rebuttal against annuities and why, and what are some of the key considerations?
Well, so I think it's really interesting. I think, maybe first, if you wouldn't mind, maybe let's take a quick step back, define what an annuity it is, first and foremost. And second, you mentioned it, the vast majority of cases, it probably doesn't make sense to go with an annuity. But maybe we can start with, for the cases where it does make sense, and then we can use that to contrast against a lot of the other ways that annuities are used and sold and actually put in place.
An annuity in its most basic form is the act of handing over your money to an insurance company in exchange for a income stream in return for that lump sum payment over some period of time,
Right. So you tell you're
either
basically you're
now or
telling
in the
me
future.
like, but you're like telling me guaranteed income, right? Like that's the big sales pitch.
The sales pitch is that this income is guaranteed, and that guarantee can also take many different, shapes and forms. It could be a guaranteed specific payment for the remainder of your life. It could be uh, a guaranteed payment anchored to some benchmark or index return plus or minus some certain amount over your life, um, or for a certain number of years. And essentially, that's where a lot of the variation comes into play. But for all intents purposes, it's guaranteed contractually.
So it sounds like a pretty good deal then, right? Like you're telling me that I hand you over some money, probably a pretty big chunk of money, but you're guaranteeing me some, payoff in the future. Why wouldn't I do that?
One of the things we get really excited about when it comes to planning for the future is talking about this concept of flexibility. Usually when people retire or they accumulate enough wealth to retire, they've got some idea in their mind of what they want life to look like, for the potentially several decades of retirement that they're going to be living. And, we know how hard it is to forecast, down the road, whether it's 1 year, 5 year, 10 year, let alone, God forbid, 20 years. Predicting the future is very difficult. So we might have an idea of what we need to spend. We might hand over a lump sum to an insurance company in exchange for a payment that equals exactly what we need to spend each year for the rest of our lives. But what am I missing in that explanation? What might happen? It's we might want to spend more money at some certain point. We might want to take out a lump sum and buy a second home or renovate our house or give money to family, or we might have unforeseen medical expenses that are of significant expense that was unplanned for. It's the lack of liquidity and flexibility in your plan. So it might sound great to give this lump sum to someone else and say, you invest it, you manage it, you take all the risks, just give me my paycheck every month. But there's a lot to be said about losing that flexibility. And from an investment standpoint, Andy, this has got to get you jazzed up, right? Like, one of the biggest and simplest concepts in investments is around opportunity cost. And
Yeah.
so, like, what
Yeah.
I mean, what's the next derivative of this?
Right. Yeah. No, there's this invisible cost to this that you don't even see, right? So we're not even talking yet about fees and expenses of these types of products. But the fact of the matter is, when you're giving money away and saying, hey, someone else take on the risk, well, you have to pay them to do that. And I'm not talking about fees. So what's happening is when the insurance company is going to go invest that money, they're not fools, right? They're not going to take this money and take a loss on it. But so they're going to be earning a spread over and above what they're going to pay out to you. So when we take a look at what the amount that's guaranteed is, obviously every single policy can differ. Not you can get quotes for all sorts of different types of annuities with different types of payout streams. But typically, in my experience, what I've seen is that the amount that you're going to get paid out in the annuity over the long term is a lot less than it would otherwise be if you were taking the risk yourself and you were investing that money in stocks or whatever the right asset mix is for your personal situation.
Right. So if you hand over $1 million and you annuitize it and you're guaranteed, let's be generous and say 5% per year for life, what could we compare that to from an investment standpoint? Say like a moderately risky investor, someone who
Sure.
is willing to invest that same amount of money at a 5 or 6 out of 10 on the risk spectrum. What are you
Yeah.
looking at in terms of delta?
Yeah, exactly. So we just had this conversation in our recent episodes where we're talking about when you retire, you're I mean, you are investing for a very long time frame, right? We're not talking about 5 years, 10 years. It can be 20, it can be 30, it can even be more than that, right? So
Sure.
these percentage numbers over that long of a time frame really are massive. So I would say that, if you're getting a pretty good annuity payout of 5% guaranteed over the course of the rest of your life, that's decent returns. But if you're in that, let's say, you're in a moderate risk tolerance, I mean, I think you could easily be getting somewhere around 7 or 8% out of that money. And that may not sound that big of a difference, and you're taking risk to try to generate those types of returns. But little like 2-3% return differentials over a long time frame make huge differences in ending wealth. So I would say that on $1 million policy, I haven't done the math on this, but you're probably sacrificing hundreds of thousands of dollars in returns over, say, a 30-year time frame.
Right, and that's based on what's happened historically. We all know that famous saying, past performance isn't, predictive of what's going to happen in the future. But the general theme of what you're saying is the annuity payouts, one of the biggest, typically with a fixed annuity, one of the biggest drivers of what the payout looks like is the current rate of interest in the
Mm-hmm.
economy, which is in many ways tied to inflation, the general economic conditions. So, in a variable annuity, that'll be more anchored to the returns of some sort of public market, typically equities. Uh, so I guess what you're saying is that because and it actually makes sense when you simplify it. It's if I'm transferring the risk to someone else, it makes sense that I should get paid less because I'm no
Mm-hmm.
longer willing to accept the good, the bad, the ugly. I'm locking in something for potentially several decades. So it makes sense in theory that the insurance companies would want to pay me less. If I'm willing to shoulder that risk myself and I'm prudent with how I invest and I revisit that and I, go through my planning exercise and I think about all the factors along the way and adjust as needed, because I'm taking that risk myself, I'm paid just by the markets, I'm paid some sort of a premium
Right.
over and above a less risky vehicle for taking on that risk. And as long as you can hang in there with your advisor, you should achieve something over and above what a fixed annuity would pay. So I
Yeah.
think that totally makes sense. What about the variable annuities? The annuities where they say, and you see this marketed all the time, you get, you know, upside participation with downside protection is that sexy catchphrase. The idea that you can participate in the ups of the market, and when it goes down, you only get some of it, or maybe not any
Mm-hmm.
of it. What
Yeah.
what is the one? What is usually the missing piece of that argument?
So, yeah, I think you just have to realize there is no free lunch in investing in finance. So, when a sales pitch like that comes across your desk, and it seems like it's too good to be true, I mean, it probably is too good to be true. Because what's going to end up happening oftentimes is maybe, I mean, and there's different products that are all kind of different. This kind of reminds me of a lot of these like structured notes that we hear about as well,
Yeah.
where it's like, well, you get this payout structure if the market does this, and then you're capped on the downside. But there's always another cost to that. Sometimes you're capped on the upside potential. So in a really strong bull market, say the market's up 20%, you're not necessarily achieving that full 20%. And then what I've seen too sometimes is on the downside, you might have some level of protection up to say at 10%, but then you're not protected on like a catastrophic loss sort of thing as well. So, I think you'd really want to dig into the details whenever you have a variable annuity or a structured note or anything that's promising predefined payout structures. I think you really want to get a good understanding of what's driving that and where the missing pieces are. Because I think the more complexity you add to an investment product, like I think the harder it is to really understand what's going on, and the easier it is to get some negative surprises.
Real quick, the only you had said, let's talk about the case where it might make sense. I'll say this. The only instance where I've seen an annuity really make sense, I've never personally recommended one, but I've seen instances where this has happened. If someone has a very limited savings pot, they have not accumulated enough money to really live off of long term, and they need some sort of an income stream from that amount of money, and they're really spendthrift. They are worried about spending it down too aggressively, and they literally can't afford to run out of that money. Then they might annuitize and just say, you know what, I need to just know I can get this
Hmm.
paycheck as long as I'm living. I'm willing to give away everything else. Just give me my X amount of dollars a month. That way I can't overspend. I can't, I won't worry about, really essentially going financially destitute. And that's really it.
I'm guessing that doesn't describe most of the people listening to this podcast.
No, no, exactly. It's a rare case, but that's not usually the way they try to sell these things. So speaking of fear, we are in the second half of 2025, third year in a row trending on really great recovery from the 2022 uh, heavy sell off in the stock market, and we're already hearing about the R word again. People are afraid of a possible recession. So let's workshop that right now.
Hmm.
Recession, no recession. Some people say it's a guarantee. When I say, this isn't mostly economists, but this is clients and listeners who are really worried and concerned about a recession. What do you say?
Yeah, well, yeah, I still remember in what was it, 2022, where Bloomberg said 100% chance of recession. It was one of their big headlines.
Right.
We're still waiting. We're still waiting for that recession to happen. I would say that, for clients, I totally understand where the fear comes from, right? We live in uncertain times geopolitically. We live in uncertain times, just with economic policy and all the tariffs and all the stuff that you see on the news every single day.
We're always
and
in
at the
uncertain times.
and at the same
Yeah.
time, like, the stock market's at all-time high, so it's kind of
Right.
like, is it Will Ferrell who says this? And I feel like I'm taking crazy pills, right?
More
Like,
cowbell? No.
yeah, but like, I can see where someone would be like, looking at their balances, they've never been higher, but at the same time, it just feels like there's all this risk going on all the time. So, like, I totally kind of can empathize with that. I would say that if there's one thing that the U.S. economy has shown, really, over the last, what, 15, 16, maybe longer years, is just don't
Forever.
bet against the U.S. stock market.
Right.
Right? Like, until proven otherwise, people have been bearish for year after year after year for all sorts of reasons: COVID, inflation, now tariffs, right? There's
Trade
always
war.
something. Right. There's always something out there that's going to be scary, and it can cause you to take action when you don't need to. And to me, that is where we are. Keep in mind, I think it's really helpful to keep in mind what the stock market is, right? So people always look at the stock market and say, hey, well, that's a bubble. That's irrational. But the stock market is the combined opinion of millions of people who are literally putting their money where their mouth is when it comes to investing in the 401k balances, in individual stocks, in individual asset classes, right? They're putting their money where their mouth is. And so it's the combined wisdom of the crowd, all the people, regular, Robinhood traders, hedge fund traders, advisors like us, like Vanguard. There's all sorts of different players in that mix, and they're all coming to a point and agreeing on the price. And so, because there's so many players, there's so much information that's already baked in to the stock prices. I would view the current stock prices as a pretty good indicator that things are probably okay right now.
Yeah. Well, I think it's funny because there is a lot of noise. There's always uncertainty. You see those charts that say, the reasons to sell over the last 100 years, all the different global events that have happened. We've had 20, almost 25 recessions since 1900. Each of those has coincided with a really healthy recovery in the stock market. So a lot of these things are just like features: uncertainty, the noise, wanting to yell at the stock market, this doesn't make sense. That's just a natural part of investing. But especially the last 10 years, when we've had the 2018 trade war, COVID, uh, the 2022, the crazy hikes in interest rates, and all the supply chain shocks, and then this year with the tariff, uncertainty. If you look through all of that, earnings growth of U.S. companies has just been upward to the right.
Right.
Companies have grown their earnings through all this craziness. And That's really all that matters at the end of the day. Doesn't matter who's president, doesn't matter, all these other factors. If companies can still generate a profit and grow those profits through all the noise, then stocks are going to look through anything that's happening
Hmm.
today and say we're going to be okay. And on top of that, you throw into the mix this whole movement with AI, which we talked about a couple episodes ago, about just the general advancements that are happening, the benefits that's going to have not just the seven companies, but all companies will benefit from this in some way, shape, or form, and what that means for productivity and for profitability of both public and private companies going forward. There's a lot to feel good about. So I think we're still in that like if you look at employment, you look at profits, you look at inflation, you look at rate cuts, at the Friday are apparently definitely happening in September, then what's there really not to feel good about? What would tell you today there's a recession coming?
Yeah. And I think the thing you have to keep in mind is like the things that will crash a stock market or negatively impact an economy are like things we don't see coming. Like a virus coming out of China, right? Something that comes out of left field that the market's not seeing, that's not really priced in, that just, it's just exogenous shock, right? And I guess that's a fair question to ask. Like, what is that right now? And the correct answer is probably like if there is something, none of us see it, right? Otherwise, stocks wouldn't be at all-time highs like they are right
Right.
now. But if you're concerned about immigration policy or inflation or the trade war and how that's going to interact with our standing when it comes to the dollar being the global reserve currency, right? There's all these things that everyone's concerned about. That's probably not going to be the thing that ends up being the issue if and when the market does sell off again. So the one thing I can tell you, I can't use the word guarantee for anything, right? That's not what we are, but I can guarantee you that the stock market will crash again at some point in the future. We know that, right? There's going to be a bear market, 10%, a correction, 10%, fall, usually about once a year, and then a bigger bear market, so 20% plus, once about every 5 years, right? That's just going to happen, and it's going to be something that we didn't see coming. But right now, what I'm looking at is a lot of risks that are pretty well priced in by the market. So,
Yep.
like, is the market going to be that surprised if we see inflation on goods coming in from overseas start to rise at some point in the future? Probably not. And the expectation is probably going to be this is a one-time price shock, and then the inflation trend's going to go back to normal. So I think that's why the stock market isn't overreacting to this, because these are things that are telegraphed, these are things that are known and seen, and quite frankly, if you're reading an article about it on Wall Street Journal, chances are it's already priced in.
Yeah, yeah, that's like the magazine cover indicator. Normally, if it's on the cover of The Economist or Money Magazine or Bloomberg, it's not any news that's special, and it's actually potentially contrarian to what might happen. There was I think it was The Economist back in the spring had the cover talking about like American exceptionalism being
Right,
dead and no more.
right.
People don't want they don't want to invest in the U.S. anymore, and like literally the opposites happen, and the markets ripped back and recovered, and then some. So keep the faith. That's the simple term we use
Yeah,
internally and have well before Andy and I joined, and that
yeah.
saying lives on.
Yeah, that probably was in the running for a podcast name, but
Yeah.
we didn't want to be confused with a religious podcast. So
So
probably that's why we chose long story short.
other fear mongering thing here
Yeah.
that I think the last couple weeks has come up: the AI rally losing
We were just
steam.
talking about the AI,
Our tech
like the
our
AI
tech
trade being
stocks
back.
dead. Our tech stocks dead. I feel like I'm playing ping pong with my brain every week. Tech is in, tech is out, tech is in, tech is out.
Yeah. Snip, snap, right? That's how
Yeah.
these headlines are going.
Yeah.
uh,
So what is it? Is
yeah,
it
yeah.
alive? Is it
Well,
dead? I mean,
yeah, I wish I could pull up my screen here and show you because I saw these headlines last week and I was a little confused by them as someone who really does follow this stuff, all the time. It's my day job, right? I was like, why am I getting these push notifications that are saying like the AI trade is falling off? So I pulled up Nvidia's price chart and you look at like the week and like, okay, yeah, it's red a couple days in there. Then I pull it back to year to date and I'm like, this thing is wildly in the green, right? Like you can, if you squint, you might be to see a little bit of a tick down in prices. So no, I would say that the fears about the AI trade unwinding are a bit premature. We're probably still in the early innings of this thing. I know people love to say the B word. We talked about the R word, recession. Now we're going to talk about the B word when it comes to bubble. And sure, we might be in a bubble when it comes to these types of stocks. But I mean, Nvidia are still selling ungodly amounts of chips with insane profit margins. When I look at a lot of these, Mag 7 stocks, they report great results. They look like they're going to report great results again. Maybe at some point that'll stop. But when people say the word bubble, I think in their head, they jump back to, like Conan O'Brien would say, in the year 2000, right? When the
Mm-hmm.
tech bubble burst. And so that was like a really scary thing because, yeah, I mean, stocks fell, a lot of stocks never recovered. Huge differences between then and now. In both, the similarities are there was a potentially transformative technology that was coming online and all sorts of new businesses were being created. So that's the internet versus AI now.
Mm-hmm.
But what's different is back then, most of these companies, or many of these companies anyways, weren't profitable. Like they were just burning cash. And so it was not a huge shock that these companies, eventually the bill came due and they crashed and burned. These days, the AI trade, these are insanely profitable, high quality companies. And so because of that, like I just think that the risks are mitigated there. Could we be in a bubble? Are valuations stretched? Are they historically high? Sure, but valuations alone aren't necessarily a reason for stocks to start selling off. If we've seen these companies be expensive for a long time and continue to push gains forward. So I would say that like a 1 week, tick down in terms of, tech stocks, maybe a little premature to call the whole trade dead.
And I don't even know what constitutes a trade being dead. Like how,
Yeah.
what, how? I mean, these stocks are naturally a little more volatile, and these sell. I mean, they've sold off significantly several times over the past few years, and each time found their footing because of what's happening in AI and all the money flowing into it and the interest in it from the investment community. But like we said an episode or two ago, the AI trade is not just seven companies. The AI trade is the global economy, really. I
Yeah.
mean, again, they might be the makers and the drivers of this, but the benefit of AI is going to flow and stretch well beyond that.
Yeah, this is something that I think about a lot is like when I think back to like 2015, 2016, 20, that era, like it was amazing how cheap it was to call a taxi with Uber, right? It was
Mm-hmm.
amazing how cheap streaming services were. And that was like it was what Netflix may have been what $5, $6 a month or something. Like all these streamers were coming online with these like cut rate. The whole promise of like a YouTube TV or something like that was like, oh, cut cable, it's $35 for the same thing.
Mm-hmm.
And what we've seen since then is all that stuff I just talked about is a lot more expensive now, right? Like eventually they grabbed a huge user base and then raised prices to monetize it. Honestly, I feel like that's where we are with AI. Like I see a lot of parallels to that, where like right now there's all sorts of these great AI tools that are really cheap to use, free to use. If it's free, you're probably the product at the end of the day. But still, like right now, there's a lot of useful stuff you can get out of it for real cheap. And to me, like I just think back to how cheap Ubers were in 2014, and I'm like, that's what this is, right? Like, so take
Yeah, yeah,
advantage of
they're
these
on to
things while you
something.
can,
They're on to
while you can.
something,
I
without
promise
a
you, they'll
doubt.
monetize at some point.
Well, should the U.S. government be monetizing via
Yeah,
investment stakes now?
yeah, this was a good one. So this is the first I've ever seen this happen in this country. So like, I don't know if I should say this or not, but my first thought was like, is this socialism? But then I looked a little bit deeper into what's going on, and so the federal government, the big news was they bought a 10% stake in Intel.
9 billion.
Um, yeah, my first thought was like, wow, I'm surprised that a 10% stake in Intel is only $9 billion. That just goes to show you how far that stock has fallen. Maybe they're value investors. Maybe this is the sign that value stocks are coming back. But really, what's going on is this funding is coming from like the CHIPS Act that was passed under the Biden administration, or a big chunk of
Yeah.
that funding is. And so rather than just giving that cash to the company, they're using it to purchase an ownership stake in the company, right? So you can think of it almost as like a win-win, so to speak. Whereas like the company itself is getting a cash infusion that hopefully it can use to like turn around its fortunes again. Intel has been a hugely disappointing stock over the last year or more. But then it's not just a gift. There's something that could potentially grow in value coming out of that from the U.S. government's perspective. So from that perspective, like I think it's fine. As of right now, there's no board seat, no governance. Maybe there could be conflicts of interest in the future. So that's what's happening. That's sort of like the why, and really the why comes down to like reshoring semiconductor manufacturing here. That's going to be a really big deal, especially with all this talk about AI and the segment that we just went through. But there's a national security angle to this as well, where like the federal government wants to keep advanced chip making here and make sure that they have access to the best chips, and so helping fund an American company like Intel makes sense. I would say that if you're a shareholder of Intel, I know the stock popped, but this may not be the best deal for you. For one, I think it's something like 75% of Intel sales are international. So if there's the perception that the U.S. government has their hands all over this company, maybe that will harm international sales down the road. But also, this 10% stake is dilutive to your holdings, right? So like basically 10% of shares were issued for this purchase. And so now like we talk about share buybacks being the same thing as dividends because your ownership stake increases after the buyback. This is sort of the opposite, where your stake in the company is actually less valuable now than it was before because there's now more 10% more shares out there, right? And so you own less of the company as a result of this. So it's maybe not as good of a thing as it looked at first. I would say that for the overwhelming majority of investors out there, this qualifies as interesting storyline, maybe a fun thing to follow, but ultimately completely irrelevant to your financial plan, to your investment strategy.
Yeah, I think
Um,
personally, yes, I'm more interested in like the free enterprise
mhm.
piece of this, right? Like I feel like I get confused today with political parties and like who is in favor of what and who's not. Like this to me, I would never see a Republican president doing this. Like if you would have
Mhm.
told me 10 years ago, like we're going to take a stake in a US company and it's going to be the president of the party that's like pro capitalism, free enterprise, I would have probably scratched my head and been like, well, how do you connect the dots there?
Right.
Um, so I get, like you said, I kind of see why I get it, like in terms of the thought process behind it. But it's kind of like also like a, just from like a pure investment standpoint, Intel's been a dog for a long time.
Mhm.
It's like, is this a good investment? Like, is it gonna like, you know what I mean? It's like
Yeah.
we want to push forward the production of chips in the U.S. National security. I get all that, but like you're kind of taking a company that probably would have just totally fallen off a cliff and was not in any way, shape, or form going to catch up to the other big players, and you're giving it a like kind of
Yeah.
a smallish
Are you
boost. I'm like, what
throwing
are we?
good money after bad, right? Like, is that kind of, that whole thing?
Yeah, and I just like I'm a wonder what kind of precedent it sets, right? I would say like most
Hmm.
people don't want the U.S. government taking stakes in our company, like full stop. Um, is this going to be a new thing that's recurring? What does it look
Yeah.
like? And what kind of commentary do we get from our politicians? Like, if we do this perpetually into the future, it's going to be really,
Hmm.
really interesting to watch. People say it's taxpayer dollars. If Intel gets it together, though, and this ends up working, then people are going to say this was like a brilliant move
Yeah.
and it was great. But
Yeah.
I don't know about Intel, but I'm just like this is not a trend. I don't think anybody's like super excited about.
Yeah. Yeah. It's I like somebody said, it's a storyline to watch.
Yeah.
It's been signaled that there might be more of these deals, and I think what you're going to see is you're going to see companies, play ball with, I mean, a CEO and, basically, the board, right? they have a fiduciary duty to their shareholders to try to maximize shareholder value, right? So from their
Hmm.
perspective, if you're saying, look, if we can get this, infusion of cash, maybe that's what we're gonna do. We're gonna do that, right? So I think this kind of highlights the flexibility of companies. So I think there are some companies out there that would say absolutely no and stiff arm such overtures. I think it's really interesting that Intel felt like they needed some sort of cash infusion here and would agree to taking on, issuing, a stake from the federal government.
Right.
That to me that's a fascinating storyline. Maybe it says a lot about Intel itself. Um, we'll see because what you want to avoid is the appearance of like crony capitalism, where it's just like,
Hmm.
well, the company now has to do something for the government so that they can get what they want in terms of funding or whatnot. Now, we're starting to sound a lot like China all of a sudden with, we saw what happened with Alibaba, right? Like Jack Ma had to go into hiding because the company got too big and powerful, right? That's probably what we want to avoid here. So we'll see what happens. Again, like I said, probably something to watch. I think by and large, I would guess this is like an isolated case and something that probably won't be more widespread. Who knows? I could be wrong.
Well, the stock popped, what, 20% since they announced this? So,
Yeah.
return on
Well,
taxpayer dollars.
yeah. Well, good. That helps offset the dilutive nature of it.
Yep.
All right. So, Adam, I got a question for you. So as we said, the college football season is starting. I am actually, you asked me what I'm really excited about. I am going to see, I think it's Big Sky Football, University of Montana, in a couple weeks. Go Grizz. I have no tie to the region. It's just a beautiful stadium, cool town. I love, whole hog college football, the whole thing. Like I said, for you, bucket list stadium. Where do you want to go take a trip?
The big house.
Yeah, that'd be cool. I've heard
Yeah.
it's quiet there. Sorry to any Michigan alums on listening.
Like the stadium's quiet on game day?
That's what I've heard.
Wow. You probably heard from an Ohio State fan, maybe.
I probably have.
Of
I
which
do
we
have
have many.
family.
We love, we've got a lot of, I was actually thinking earlier, like, what fan base is most represented in our client base? I think Ohio State is up there.
Yeah.
Um, but Ann Arbor is a really cool. I've been Ann Arbor, the town,
Hmm.
and it's got a lot of cool things. Got good food, and the stadium is ginormous. I've never seen anything like
Yeah.
it in my
It's like
life. So
100,000 people, but
I
it's a
just
bowl,
like,
right? It kind of built into the
yep,
ground. Yeah.
yeah. So I would put that up there. But probably maybe even behind going to see Virginia Tech again when they're a half decent football team. I would still take that any day at Lane Stadium.
For sure. Well, I'll echo the Go Hokies chant there. Appreciate everyone hanging with us to the end of this episode. We've begun to get some submissions on questions. So if you do have any, feel free to leave a comment or email us at longstoryshort@bernie.com, BURNEY.com. For Adam Newman, I'm Andy Pratt. Thanks for listening.
This podcast featured Adam Newman and Amy Pratt of Bernie Wealth Management, which is a division of the Bernie Company, an investment advisory firm. Adam is managing partner and is chartered financial analyst, certified financial planner, master of taxation, and retirement income certified professional. And Andy is senior partner and director of investment strategy and is a chartered financial analyst and chartered alternative investment analyst. Long Story Short involves general discussions of a broad range of current financial topics related to financial planning, taxes, investment, and retirement. This content is for informational and educational purposes only and is not intended as personalized investment advice or recommendation. It does not take into account your financial situation. You'll need to consult with a qualified financial advisor or professional who is familiar with your specific circumstances. Investing involves risks, and past performance is not indicative of future results. The Bernie Company is an SEC-registered investment advisor. Registration with the SEC or any state securities authority does not imply the Bernie Company or any of its principals or employees possesses a particular level of skill or training in the investment advisory business or any other business. Bernie Company does not provide legal, tax, or accounting advice, but offers it through third parties. Before making any financial decisions, clients should consult their legal and/or tax advisors.